All right, welcome. Have you ever looked at a stock price? You know, those numbers flashing on the screen and just wondered, what is that company really worth? Well, that's exactly what we're going to dig into today. We're talking about fundamental analysis. Think of it as being an investment detective. So let's jump right in. So let's start with the big question, the one that's at the heart of all of this. When you see that stock price, is that what the company's actually worth? Or is it just, a snapshot of the market's mood in that one single moment? Fundamental analysis is the tool we use to try and find the real answer. And this really gets to the core idea. See, on one hand, you've got the market price. That's what it costs right this second. It's influenced by news, by hype, by fear, all sorts of emotions. But on the other hand, you have the intrinsic value. That's what the thing is truly worth based on its actual financial health. And the whole point of this exercise? It's to figure out the difference between the two. Okay, so here's the official definition for you. This isn't about staring at charts and trying to guess where the lines will go next. Nope. It's about being that detective. You're digging into economic data, you're poring over financial reports, all the real-world stuff that gives an asset its value. The core belief here is that while market prices can be kind of wild and emotional, eventually they tend to come back home to their fundamental, intrinsic value. So, to find that value, we're going to start from the top and work our way down. Before we even look at a single company, we have to understand the world it's living in. Let's think of the whole economy as a patient, and we're about to give it a full health checkup. Right, so just like a doctor checks your heart rate and your blood pressure, an analyst checks the economy's vital signs. Why? Because a strong, growing economy is a great environment for companies to thrive in. A struggling one? Well, that makes everything a whole lot harder. It's all about understanding the context. First up, we've got gross domestic product, or GDP. The easiest way to think about this is it's the total price tag for everything a country makes and does. When GDP is going up, it means the whole economic pie is getting bigger for everybody. More jobs, more income, more chances for companies to grow. It is the ultimate sign of economic health. Next on our checklist is inflation. I like to think of this as the silent thief that makes your money worth a little less over time. Now, a tiny bit of inflation can actually be a good sign. It means the economy's humming along. But when it gets too high, it starts eating into profits, it makes consumers nervous, and it pretty much forces the big banks to step in and do something about it. And of course, there's employment. This one's pretty straightforward. When more people have jobs, they have more money to spend. And all that spending is what fuels companies and drives the whole economy. So, seeing low unemployment numbers, that's a really powerful sign of a confident consumer and a strong economy. Okay, so we've got these vital signs, but they don't just move around on their own. There are some very powerful groups out there whose whole job is to try and keep the economy steady and growing. Let's take a look at who's actually pulling the levers. You can basically think of it as two main control panels for the economy. On one side, you have monetary policy. That's run by central banks, and their biggest, most powerful tool is interest rates, the cost of borrowing money. On the other side is fiscal policy. That's the government's turf, and they manage it through spending and taxes. And you can see a really clear cause and effect here. Let's say inflation is getting too hot. A central bank might step in and raise interest rates. All of a sudden, it's more expensive to get a mortgage or a business loan. So what happens? People and companies start to pull back on their spending. That cools down demand across the economy and hopefully gets those rising prices back under control. Okay, so those big picture policy decisions have very real impact on the actual companies trying to do business. Now that we've checked the patient's overall health, let's zoom all the way in and put one single company right under the microscope. First thing we look at is the balance sheet. The absolute best way to think of this is like a financial snapshot, taken on one specific day. It just lists everything the company owns, those are its assets, and everything it owes, those are its liabilities. And whatever's left over, that's the equity. That's what the owners actually have a stake in. So if the balance sheet is a snapshot, then the income statement is more like a movie. It tells you the story of how a company did over a period of time, like a quarter or a whole year. It shows you all the money that came in the door as revenue, all the money that went out the door as expenses, and then it gets to the most important part, the bottom line. Did they make a profit or did they take a loss? Now, let's be honest, those statements can be a a little dense. So analysts use these things called financial ratios as shortcuts to quickly check on a company's health. For instance, return on equity asks a simple question. For every dollar the owners have invested, how much profit is the company spitting out? The current ratio wants to know, does the company have enough cash on hand to pay its bills for the next year? And debt to equity tells us who's really bankrolling the company. Is it the owners or a bunch of lenders? These are the vital signs, but for just one company. So we have the huge, big picture economic view, and we have the super detailed close-up company view. The final step, and the most important one, is bringing it all together to actually make a smart decision. Generally, analysts take one of two paths. There's the top-down approach, that starts with that healthy economy we talked about, finds a really promising industry inside it, and then hunts for the best company in that industry. The bottom-up approach is the complete opposite. It starts by finding what seems to be a fantastic company, and then it works backwards to see how its industry and the wider economy might affect it. Now, as you can imagine, this is a ton of data to try and connect. And that's where modern tools have become a total game changer. They can sift through all these different moving parts, connecting a change in interest rates all the way down to a single company's future profits. And they turn all that complexity and noise into a clear, actionable idea. And this quote just nails it. Fundamental analysis isn't just about looking backwards and explaining why the market did what it did. It's a practical tool. It's about giving you insight into when and how it might move in the future, giving you a sort of map of all the forces that are shaping the market as we speak. And that leaves us with one last thing to think about. We can gather all the data in the world, we can run all the numbers, we can analyze every single report. But at the end of the day, when you have all those clues laid out in front of you, does that final call still come down to that uniquely human thing we call judgment? Something to chew on.